Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that sums up market movements and key events from the past week along with their implications on asset markets. I'm Michelle Castellino, your host for this week's episode. On the global front, June US inflation surprised on the downside, with both headline and core CPI coming in below expectations, while producer prices also moderated. The softer inflation backdrop, coupled with easing retail sales, gives Fed greater flexibility, reinforcing our view that peak Fed hawkishness is likely behind us and that rates could continue to remain on hold through H2 2026. However, the steeper decline in short-term yields relative to long-term yields suggests fiscal concerns continue to keep the term premiums elevated. Meanwhile, oil prices remain firm amid renewed US-Iran tensions and concerns around the Strait of Hormuz. We expect crude to test the upper end of our 70 to 90 USD per barrel range in the near term. Although, any move significantly above that level is likely to prove temporary. For gold, higher rates and a stronger dollar may slow the pace of gains and prompt some near-term profit-taking. Nevertheless, gold remains our preferred strategic hedge, with our 12-month target of USD 5,100 per ounce, supported by sustained central bank purchases and ongoing reserve diversification. Now, on key India macro data that was released the last week, India's retail inflation accelerated more than expected, with the June CPI rising to 4.38% from 3.93% in May, pushing past RBI's 4% medium-term target as elevated food and fuel prices fed through. Wholesale prices told the same story. June WPI climbed to 9.87% from 9.68% in May, as a sharp rise in food and primary article prices more than offset some of the cooling in energy costs. On trade, India's merchandise deficit widened sharply to $30.43 billion in June, up from $19.10 billion a year earlier, with imports up nearly 31% to $70.84 billion, outpacing export growth, which came in to the tune of 15.5%. On a more encouraging note, net direct tax collections were up a healthy 16.4% year-on-year, powered by 22% growth in corporate tax and a near 48% jump in securities transaction tax receipts. A sign that corporate profitability and capital market activity both stayed resilient. Now turning to Indian markets, it was a firm week for the headline indices even as the broader markets lagged. Nifty rose 0.53% to close at 24,334, while Sensex gained 0.75%. Mid and small cap indices, however, lagged for the week, with the mid cap index slipping 0.97%, while small cap index eased 0.62%. IT was the standout sector, up 4.34% for the week, as it benefited from expectations of Fed easing following softer US inflation data, which improved the outlook for US technology spending. Some of the big tech names logging in a resilient start to Q1 FY27 earnings also boosted the sentiment. Auto was next, up 0.89%, followed by banks up 0.8%. On the other hand, realty was the weakest performer for the week, down 2.12%, as higher than expected CPI print for India, which in turn increased the rate hike expectations, made borrowing costs look stickier. On currency and bonds, the rupee weakened further, up 1% against the dollar to close at 96.28, breaching the 96 mark and extending its recent slide as the oil spike and broader dollar strength weighed on the currency. On bonds, India's 10-year benchmark yield rose about 6.6 basis points to 6.78%, its third straight weekly rise. That's all for this week's edition of The Week That Was. If you found this update useful, don't forget to like, share, and subscribe. Thanks for tuning in and have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.